Hey guys, so I wanted to touch on something I haven't really talked about a lot because it's honestly been occurring to me more recently. And this is going to be an explanation of the reason why I moved away from day trading. Yes, I did present you guys an easy opening balance strategy that it doesn't work all the time, but when it does work, you can catch massive moves intraday. But even that stuff is like it's small fry stuff. Okay, these markets are not built for day traders. Okay, let me say that again. These markets are not built for day traders. Do you know why markets move so randomly like this? And I know it's not completely random. Obviously, you can look at this thing or that thing, this ICT concept, that ICT concept, and say it's not completely random. And no, it's not. But it's hard to predict intraday moves because there's very little fundamental bias other than like an earnings play or some news driver that will actually give you a legitimate reason to believe price is going to move or change directions or something like that, right? These things are moving based on high time frame objectives. Okay, the people who make money in these markets, like the big money, I'm talking big whale investors, like people who are millionaires, multimillionaires, billionaires. Okay, we're talking people with 8+ figure accounts, maybe 9-figure, 10-figure accounts. Okay, these people, or I'm not saying they have that much in one account, but net worth that they trade with. Okay, these people, like the way billionaires trade in multimillionaires trade is this. Okay, they know when bull and bear markets are going to happen. They know about the news manipulation stuff that I've tried to explain to you guys. These people hold positions for like entire lifetimes. Okay, but also what they do is they DCA into these positions. Okay, and also if they're a better trader, they will also actually liquidate most of their position at the end of a bull market. But then they will re-enter that position, right? So let's talk about how they do this. First, start off with your ICT. Okay, what is the fundamental concept of ICT? Is that he looks for a market structure shift at highs or at lows, right? Major highs, major lows, he looks for a market structure shift, right? Well, screw market structure shifts, in my opinion. The way that real investors are doing it are they don't care if the market gives them a signal or not. They are buying. Okay, so we say we have this end of the bull market in Apple. You know there's a bear market coming. So maybe if you're a short seller, okay, that's fine. What you would be doing, well, you could trade both sides in this kind of market. But see how it creates a major low right there? Okay, so big whales, this low, they didn't buy there, or maybe some of them did, but the thing is like a real smart trader, in my opinion, they see this low happen. Then what are they going to do? They're marking that out and they're waiting for price to come back down there. What are they doing? They're buying. Okay, so they're buying this low. This is kind of like my strategy of buying below the low of a red day, but this is it's applied in a different way, right? So a smart trader, if they're trading long, they probably shouldn't be trading long during this bear market. But as you can see, this bear market was kind of choppy. So there were definitely some whales doing exactly what I'm going to describe here. So they're going to buy once it gets back there, right? So now they have a position in here. It makes a lower low from this open also, right? Well, so obviously the open's low. So they're buying here because they would be there at the market open that day and they would see that it gaps down that much, and because it's below that low, they're instantly going to buy here. As you can see, the result of that is evident by the fact that all the whales who were doing exactly what I'm describing here saw that it gapped down lower than this low and they bought it up. Okay, so now they have this low marked out though. So what are they going to do next? If price goes below that low, they're going to be buying below that low, right? So they bought below this low, but they actually got to fill there, and then they're going to get refilled on more position below there, right? So, and then what are they going to do? Well, they're going to refer to recent highs in order to manage their position. This is if they're like a swing trader or something, right? Not like necessarily a long-term position trader, but they're going to see this high, they're going to take a partial profit there, and then they're going to take a partial profit there. They'll move their stop to break even or something, or their stop into profit, and they'll target these recent highs, right? But let's say you knew it's a bear market. Okay, so you might not be trading these long plays because you're not really trying to, it's a recession coming. based on the Michael Jenkins thing. So instead, what you're going to do is do the opposite. Instead, you're going to look for big highs, like noticeable highs, like this one, or this one. You might be already expecting a recession. So what you would be doing is you see this major high right here. This might be a bit soon to start shorting the market though, but with all the crypto crazy, NFTs, all that stuff, you might be willing. So this big high, maybe you take a short position there as it punches above, or maybe not. Let's say you didn't. Okay, so you're going to pay attention to other highs. So you've got this high, you've got these highs. So all these like relative equal highs right here, you're going to mark those out. What are you going to do? Once it gets back there, you're going to take a short position. So over here, you're taking a short position, right? And then you're going to take a profit, probably a partial profit, probably right here, right? That's going to be your first take profit, is below this low. And then you're going to aim for other lows. So you'll take another partial past this low, right? And you'll keep, and then it'll come down, cuts down, creates this low, goes back up. So then your next take partial is going to be below that low, right? Okay, so it's pretty simple, right? But as you can see, again, whales to the upside, they see this big low created right here. It punches down, makes this low, moves away from it, which kind of is a little bit of a market structure shift. But instead of buying the market structure shift, they wait for a sort of market structure shift, so to speak, and then they turtle soup it. So instead of buying the market structure shift, they wait for it to come down, take out liquidity one more time, and they're buying below the low of this candle, right? So they're buying there, and then they're going to take their profits. First partial will be here, next partial will be here, next partial will be here, and if it gets there, next partial will be there, right? Goes back down. Okay, by this time of the year, you're probably expecting a bear market to be over, because as we know, bear markets at most last like 2 years, but usually they last about 9 months or so. So October through December, you're probably expecting the bear market to be coming to an end. So where are you looking to buy? Well, first, there's these relative equal lows right here. So a whale, and this is what's causing price to move up after these periods, a whale's buying there. And then also below this low that was created in June, they're going to buy right there, because their sell stops are being hit. People who put their stop loss there, like semi-decent whales who put their stop loss there, are going to get taken out by bigger whales who don't use a stop loss, and they just DCA. If the lower it goes, the more they'll buy at the end of a bear market, right? Or even through the whole bull market or a bear market. They can just DCA here, they can just keep DCAing. I saw the guy who owns Business Insider, he's this German guy. He just keeps buying Netflix at the first of every month. He's not buying specifically here, but it's the same idea. Even during the bear market, he's just buying Netflix every month, knowing that eventually it will rebound, continue higher, and pay him out, right? So he just DCAs into it. If it goes, or he's not even DCAing, he just keeps buying. If it goes against him, it's fine. If it goes for him, it's fine. He's just going to keep buying, knowing that it's going to keep going up in the long term. But anyway, this is the smartest way to do it, in my opinion. So you're buying below these major lows. So whales bought here, and then the market reacts to that, because the people who can move price now have positions, long positions on. They scared everyone out of their long positions. Retail sold their long positions to the whales below these stop losses, and then Apple moves up. Okay, and so now in a bull market, it's my rules are a bit different than that, because I know it's a bull market. So it's not always going to give you these really nice entries, right? So you're going to have to be DCAing a little bit sooner than that, a little bit more preemptively, right? But let's say you weren't, well, then you're waiting for things like this. For example, here, actually, did it even give it to you? No, it didn't. So yeah, it didn't really give any more re-entries or re-adds. Maybe this bank panic, you might have done that, but even that didn't take out like this low and stuff. Maybe on some other instruments it did, like other stocks. But as you can see, it's just mostly a really smart way to enter is what I'm talking about. And the whales there's people who literally bought these sell stops right here, and they're holding, and they're going to hold for like 5 more years, okay? Or they're going to hold forever. And they're going to make literally billions of dollars. Okay, well, depending on their account, right? They're going to make millions. They're going to make hundreds of thousands, millions, tens of millions, hundreds of millions, or billions of dollars doing this, okay? So, but that's where my strategy comes into play. Instead, where you're buying below a red day's low that's not a swing high, or a red week's low, stuff like that, it's a little bit more preemptive, but it's the same concept that you're dollar cost averaging, knowing the bias of the market. Okay, so does this make sense, guys? So when you're looking at the NASDAQ, when you're looking at the NASDAQ or the S&P 500, and you're trying to trade this crap intraday, and like, no offense if you really think you can be successful, that's on you, but how do you know it's going to sell off today? Yeah, it hits an imbalance. There you go. So you have an idea that it could. And if you can manage your risk well enough to trade based on imbalances, that's fine, okay? But I'm just telling you, you're going to have a really hard time doing that. It's pretty unobvious. It often doesn't work out. And like, for example, here, yeah, you'd catch a short trade, but you're shorting a long biased market. So like, how well do you think that's going to work for you in the long run? Every time you're trying to short, catch a top, like, sure, you can catch a, whatever this is, like a 150 point move or something, but like, in the grand scheme of things, 150 points isn't that much. And you know the NASDAQ's not going to crash, okay? And yeah, it could pay you out. It could go way down. But in terms of the whales and the long-term traders, this stuff is going to continue higher in the long run. 10 years from now, this thing's going to be well over 30,000, okay? Right? So, or that's just my opinion. I don't know the exact number, but that's just like, a random guess. Like, but it's going to be something like that, right? It's going to be double what it is now in 10 years. Okay, so the real wealthy people are concerned with that. They don't care about the little intraday crap, because it's so much harder. But also, the very thing is that because those wealthy people are trading these long-term positions, they don't want to share profits. So they hire these banks, and they set up this whole thing with the Fedwire system between the Federal Reserve and all the big swap dealer banks and all that. That all these algorithms will get run by all these different people. Then also think about like smaller whales running their algorithms within these markets and stuff like that. It gets pretty chaotic, right? So it's a lot harder to compete with all these stupid little day trades. And the purpose of that is to basically destroy everyone who's trying to do that. Everyone who's trying to day trade is basically giving their money to the people who are holding in long-term positions, people who are getting their face ripped off, blowing their accounts and stuff. The people who are in for the long haul, they completely dodge all of that, and all the money lost gets left by those people into these markets, and it stays in these markets. And when these long-term traders cash out of their positions after decades or whatever, years or decades or stuff like that, they're the ones making the difference that was lost by all those short-term traders who just gave it all to the market, right? So there's not a lot of point, because you don't know if today's the day that they're going to sell off the market to go attack sell stops before it moves up higher. So like, what's really the point of trying to catch all that? Because you're not, be real with yourself. Are you really that smart? Maybe after years or decades of studying this, like, maybe you'll be able to do it, right? I'm not saying it's not possible, but like, the bigger objectives, this is how people make money a lot more safely, a lot more money, just less time consuming. And also these people are actually better traders because they have an understanding of the big picture, right? So let's look at the NASDAQ, the same thing that we talked about on Apple, right? This is going to be a good example. So it's going to be kind of similar. But so expecting the bear market to end at the end of 2022 probably, right? So this big sell stops in June, whales are buying there. There's other lows, so like maybe this low right here. I mean, that's a little bit close for my taste, but there's probably some whales who are buying when it goes below that low. Wait, why is that? Oh, there we go. So like below this low, they're going to buy. Below this low, they're going to buy, right? They're just going to keep, every time it punches through a major low, they're just going to buy from those sell stops, right? And they know that they might go into a bit of drawdown from here to here and here, but eventually it's going to work out for them. And all of these positions, even the highest position they buy at, will eventually go into profit, right? Let's say you even bought from you bought like this sell stop right here. Well, that one went into profit there, so you could take a profit on that sooner. But even if you didn't, and it goes into this much drawdown, right? It might be like over 1,000 points in drawdown, but now that position is like almost 4,000 points in profit, right? So, and even if this low from March of 2022 is now in profit, right? Even this one is in profit, right? So you see what I'm saying? So a bear market's not that threatening to these large position traders who are just going to keep dollar cost averaging into these positions, knowing that eventually it will go back in their favor. They may have to wait it out for years or whatever, but these people can handle that. And it's really so you can see it's the guys with the biggest balls who actually make the most money in these markets. But it's not like this kind of strategy you can't do intraday, because if you're buying through like a major intraday low, you don't know how well they can run it down for weeks, right? Or they could run it up for weeks. So you can't do this kind of strategy intraday because you'll actually blow your account, right? But in here, if you have a big enough account, you can risk, put like 5% of your account into each buy or something like that, right? Or if you're just buying down here, you could put 10-15% of your account in these buys, right? I'm just saying, if you were like a millionaire, billionaire type person, you could put, you could buy with 10% of your account there, 10% of your account there, 10% of your account there, or like 15, 15, 15, something like that. You know what I'm saying? So that's a really easy strategy. But again, this isn't going to work intraday, right? Because if we look at an intraday chart, like let's say, well, first off, I would not do this strategy trying to short. If you're trying to long, then sure. If you're willing to hold position trades, maybe for shorter periods of time, it would be kind of the same premise where you would just be like, okay, price makes a major low here. I'm going to wait. I'm not going to do anything. I'm going to sit through all of this price action and do nothing. And I'm just going to put a buy limit order here. And then this low, I'm going to put a buy limit order here. And then this low, I'm going to put a buy limit order here in case it goes lower than that. Right? You see, this is even for a swing trader, obviously the market has a long bias, so you shouldn't be shorting. I mean, I'm sure there's short sellers who can do this, but like that's kind of sketchy, because if you're selling above this high, that worked for you here. But if you're selling above this high, then you have to sell above this high. Like, yeah, it does go into profit, but you'll be a little bit profit on this and profit on this, but you have to take profit quickly. Right? And who's telling you when you can take profit, right? Because you have to take profit quickly when you're trying to do these short trades, because there's no guarantee it's going to come back down here, right? It might never, ever go back to this price ever again, right? But in a long bias, with the long bias, you can buy lows knowing eventually you will go into profit. It may take weeks, months, years in worst case scenarios, but eventually you will go into profit if you're buying below lows, right? So this is probably, most of this stuff is probably profit taking in my opinion, right? Because it would be dumb to sell above this major high, right? Because it just goes against you majorly. And maybe it'll come back into profit on that, but there's no guarantee, because I guarantee you there's some high like this further back that it never went back down to, right? But buying below a low, it's a different story, because it'll eventually go for you. So I hope this makes sense, guys. This is really, this honestly is me disclosing like my biggest secrets for trading, like long-term position trading. I'm telling you right now, forget the frickin' day trading, guys. If you're gonna day trade, you're do what I just showed you there. Just buy major lows, but like you'll go into some drawdown. That's essentially what I'm doing, right, with the strategy, buying below a red day's low, because on the 5-minute chart, those major lows are essentially probably red day lows, right? That aren't swing highs. So that's fine. That essentially is my strategy. But again, I'm looking to hold these for long-term positions, right? If I have to roll my call options or whatever, that's fine. I don't care. But it's trying to day trade. There's really no way for you to know the objective. Okay, like you don't know where price is really going to turn around. You know places where it can turn around at this place, that place, or the other place, but you don't know for sure. And so how do I know where to take profit? Well, I take profit above highs, but I'm looking to re-enter below a low, right? So I took profit up on this day. I got kind of, I guess you could say I got a little lucky, but maybe I shouldn't have. We'll see as time goes on. But I don't really need to know an exact price to get out at, because I know that in the long run, no matter what, this thing will go higher, right? There's no, as long as inflation continues, this asset will move higher. So there's really no issue, right? So that's kind of it for the day, guys. I hope this makes sense. Look, I put out a video saying it could sell off a bit, and I know some of you guys think that the market's going to crash and you're waiting for the bottom. Please trust me, guys. It's not the way to trade it. Okay, the crash, literally, it already happened. I'm not saying there couldn't, in some black swan event, be another leg down, but I'm telling you, the big money is not positioned for another leg. They wouldn't be paying the news to say there's going to be another leg of the recession if there was. Now, I admit there's some bullish articles coming out and stuff like that. So there could be a sell-off, but again, the sell-off will be, if there's a sell-off, you're buying here, you're buying here, you're buying here. I mean, not financial advice, do your own due diligence, but if it's giving you these lows, that's a blessing. And you should be buying, I will be buying all of these lows. I will be buying here, here, and because I doubt that we'll even come back here. So if it gives me that opportunity, you damn well know that I will be buying there. Okay, and the lower it goes, if it even does, which it probably won't, the more I will be leveraging into a position. I don't care if I have to take out a loan to leverage into it. I will keep buying major lows, leveraging into this, knowing that eventually I will go back into profit massively. Okay, so that's just how this works, guys. So take care, and I'll see you again soon.